Hello guys, it's Valery from Sight Forex and we are with the episode number 7 of how to be a successful forex trader in 10 steps. Today we are going to talk about the money management in the trading. Have you ever heard that your stop loss must be 2% of your capital? Well, this is not true. There is different type of money management, and for every type of trading we're gonna show you how to properly manage your account. We'll take a look at the swing, intraday and long-term trading. So, let's begin. What is the swing trading? Swing trading is one of the most popular forms of active trading, where traders look for intermediate-term opportunities using various forms of technical analysis. Typically, swing trading involves holding a position either long or short for more than one trading session, but usually not longer than several weeks or a couple of months. By holding overnight, the swing trader incurs the unpredictability of overnight risk such as gaps up or down against the position. By taking on the overnight risk, swing traders are usually done with a smaller position size. Ultimately, each swing trader devises a plan and strategy that gives them an edge over many trades. This involves looking for trade setups that tend to lead to predictable movements in the asset's price. This isn't easy, and no strategy or setup works every time. With a favorable risk-reward, winning every time isn't required. The most favorable the risk-reward of a trading strategy, the fewer times it needs to win in order to produce an overall profit over many trades. So, what is the proper money management for the swing trading? From our experience, we must say because of the much bigger stop losses in the swing trading and because we look for a particular target of pips every month, the volume for the trade should be maximum 3 or 2% of your account. And we don't mean the stop of the trade should be 2%. The volume of the trade should be 2%. Why is this way? Take for example a trade with stop loss of 250 pips. If your stop loss is 2% of your capital, $5,000 for example, this is $100. When you divide $100 to 250 pips, that means that you have to go with 0.04 watts in a trade, and for a profit of 400 pips, you earn $160. It's just not well rewarded. You won't be able to make good profits even you have caught a lot of pips. That's why you have to use this 2% for the volume in the trades. This way, you will use lot size of 0.1 and the profit will be $400. Can you see the difference? Use fixed volume in every trade you make. At the end of the month, with fixed target of just 1000 pips, you will increase your account by 20%. Don't forget, swing trading has bigger stops, so you have to be careful with the lot sizes. Don't try to revenge the market. This is one of the most common mistakes. Don't go with bigger lot size just to make more money. Then you have lost the previous trade. This way you will increase the risk and you will go away from your trading plan, and this is never good. Okay, let's move to the next type, day trading. What is the day trading? Day trading usually refers to the practice of purchasing and selling a security within a single trading day. It can occur in any market, but it is most common in the forex exchange, forex, and stock markets. Day traders are typically well educated and well funded. They use high amounts of leverage and short-term trading strategies to capitalize on small price movements that occur in highly liquid stocks or currencies. Day traders are active traders who execute intraday strategies to profit from a given asset's price changes. Day trading employs a wide variety of techniques and strategies to capitalize on perceived market inefficiencies. Day trading is often characterized by technical analysis and requires a high degree of self-discipline and objectivity. Day traders use only risk capital they can afford to lose. This not only protects them from a financial ruin, but also helps eliminate emotion from their trading. A large amount of capital is often necessary to capitalize effectively in intraday price movements. Having access to adequate capital is very important because most day trading employs a high degree of leverage in margin accounts, and volatile market swings can trigger bigger margin calls on short notice. Okay, what is the right way to manage your trades in this trading? Since this is, we can say, much riskier type of trading and you trade during one session only, you will use much smaller stops. When you have small stops, you can use much larger volumes in order of how much you are willing to lose. In these situations, to use 2% as a stop is good. What we mean by that? If your stop is 20 pips, for example, and 2% of your account are $200, then the volume for your trade will be 200 divided by 20. This is $10 per pip or one lot. This is a good volume, and if your profit is 100 pips, you will get $1,000. This is a good risk-reward ratio. You will win $1,000, but you only risk $200. This is the advantage of day trading. Sometimes even better trades occur with 8 or 10 pips stop loss. And if you are willing to risk $200 to 8 pips stop trade, the volume will be 2.5 watts. This is $25 per pip. You can do the math for 100 pips profit. Now, some advices for you. You need to come in with some knowledge of the trading world and have a good idea of your risk tolerance, capital and goals. If you do decide that the thrill of trading is right for you, remember to start small. Going all out will only complicate your trading strategy and can mean big losses. Stay calm and try to keep the emotion out of your trades. The more you can do that, the more you will be able to stick to your plan. And now, let's move on to the next type of money management, and it is for the long-term trading. What is the long-term trading? Simply said, this is the trading that big investors use. They buy at the strong levels of support and sell at the strong levels of resistance. They might hold their positions for several months or even years. They never close losing positions. Also, they add new positions on the new trend and this way are able to make some very good profits. Of course, here are some specific rules you must know as well. One very important thing is that you can't trade long term with a small account. It is impossible. We mean that even an account with 50,000 is not okay for long term trading. When you have a trade for like a year or more, the taxes for keeping the trade are very much. And if you have 3 or 4 open trades, it is a lot. Well, they will be very profitable at the end, but it will take time. That's why you need a bigger account so you can hold all the taxes for the trades and in case if the price goes in the wrong direction. The volume for the trades should not be more than 0.5 to 1%. This is the main thing you have to know. With this volume, the price has to go 10,000 pips in the other way to shut your account. But don't worry, no currency pair or stock can make that kind of movement. With the right analysis, you can't mess the things so badly. The other important thing is when you add new trades on the trend, they must be with smaller volume than the first one. At every new trade, you must decrease the volume in half. This way your account will be safe with no additional risk. Using this type of trading, the profits will be huge. This is like the stock trading. You can only lose money if close the trade in loss. This is the cyclicality of the market. It goes up and down and always goes back where it was. It only takes time for that. You always will go in profit. And not just in profit, it will be a huge profit. If you follow the rules and the proper money management. Okay guys, this was everything for this episode. We hope you liked the video and the information in it. If you do, hit the like button, share it with your friends and subscribe to the channel. This way you are helping us to make better videos with better content. Don't miss the weekly forecast. See you next time.